So good morning, everyone. Welcome to everybody in the room on this rainy Thursday morning. Today's panel is focused on strengthening AML and financial crime defenses and how we're adapting as a financial industry to those regulations and sanctions and emerging threats. So we'll be talking about adaptation both from a banking perspective, but also from an alternative asset perspective, and then also give you a vendor perspective as well. We'll go through some of the questions that we prepared for you this morning, and then we'll open it up probably the last 10 minutes to any questions that anybody has at the end. But if you do have a question throughout the presentation, don't be shy, please speak up, and someone will give you a microphone because we're happy to take questions throughout as well. So with that, I will ask the panel to introduce themselves. So Jim, I'll turn it over to you.
Hi, I'm Jim Stubbs. I'm the head of global programs for State Street. I've been in the industry for about 30 years, and I'm very excited to see some of the technology solutions that are coming to the fore here, and look forward to looking to match some of those solutions to the business challenges and risk management challenges that we've had.
Hi, everyone. I am Liz Owen. I am Senior Vice President, BSA Officer at First Bank of the Lake, located in Missouri, which is one of the top SBA lenders, and then moving into fintech space, which is where I have kind of my expertise of building BSA AML programs, BSA officer intentionally, and BSA nerd. So looking forward to speaking on this topic.
Hi everyone, I'm Freddie Frith. I'm the Vice President and Head of Sales for the Americas at Corlytics. Corlytics is a category-leading regulatory change management platform, so we help you stay ahead of your emerging regulatory risks and comply with regulations against policies, procedures, and controls using AI. We work with 15 of the top 50 global banks, and if you'd like to learn more about Corlytics, we're just over at the big red booth.
Great, thank you, and welcome to everybody this morning. So we will get started with our first question. Where is the industry now in terms of regulatory focus and changes, and how is the industry adapting? So Liz, I'm gonna turn it over to you first, and I'm gonna ask you if you could share your perspective on the current focus areas and where you see financial institutions focusing their energy and also their resources.
Sure. So I am going to speak on this from a financial institution perspective. And I will say it's kind of just holding pattern. We're just moving forward with the things that we were told to do. And we'll move slowly and we will move methodically, even though some of the regulations, actually I'd say quite a few of them, are paused, or we're not really seeing much movement, whether it's the Corporate Transparency Act, or even just 6 days ago they came out with FinCEN, being their update on the investment advisor AML rule and how they're going to push that off until 2028. From a financial institution perspective, that doesn't really mean much. We're going to continue doing what we should have been doing. We're going to business as usual, continue building out those controls and the monitoring that we need to do, focus on the national priorities, focus on the human trafficking and anti-fraud. That might come as a bit of a challenge if you are working with fintech partners that see, hey, this got pushed off 3 years, that means we can stop, right? It's going to be really important that those of us that are in the financial industry sector continue moving forward with those things. If you've been in, the banking space, you know that it changes with the administrations, but at the end of the day, it keeps kind of moving forward in the same direction. So I don't really see much changing in terms of where we've been putting all of our efforts. Just keep doing what you're doing and work on those AML priorities.
I'm just going to add, I think that as a practitioner, that can be a benefit, because while the regulators are putting the key risks out there and giving indications as to where the banks should be moving, now we have a little more time to determine what is the most appropriate way, what's the most effective and efficient way to get there. It takes a long time to do things within a bank based on the level of confidence and to be able to demonstrate our confidence in the solutions there. So again, I think that rather than feel a relief like, oh, we don't have to do that, it's more we can do it well and we can do it more on the terms that we think are effective in terms of risk management rather than just compliant from a regulatory standpoint. So keep going.
And I think, too, when you have a time period like now, you have a chance to make those incremental enhancements that you've been waiting, that have been sitting on the side of your desk, that you know you need to make those kind of tiny enhancements on the sanctions side or maybe in transaction monitoring or on customer due diligence or enhanced due diligence. And now is your chance to do that. There are some European regulations that affect some of the banks and some of the financial institutions that have a head office maybe overseas or deal or have subsidiaries or affiliates that are overseas that's coming down with AMLR. So it'll be interesting to see how that impacts us as well. But yeah, from the US perspective, I think we have a chance to make those enhancements and take a step back and see, do we have everything in order? And Freddie, from your perspective, how do you see fintechs adapting? And do you see fintechs looking to the banks at all for best practices? And what are some of those best practices?
So I think there's an interesting, two-way learning dynamic between banks and fintechs. And maybe this is an obvious point, but on one side, banks have the regulatory muscle, and that's from years of experience of managing complex regulations across the globe, across different business lines, but they ultimately can fall victim to the legacy systems and processes that are in place. On the other side, you have fintechs, and I guess it's in the name, technology they lead with, and user experience comes first, but ultimately they may fall victim to the lack of knowledge and be able to understand, have I executed this compliance with regulation effectively? And sometimes there's that trade-off between, am I going to adopt a banking's best practice, or are we going to move forward and focus on revenue? I guess the interesting part is the convergence of the two. And I think you touched on that just lightly in a moment, which is, fintechs are now looking to the banks for best practices. They're hiring senior leaders, and there's lots of great examples, Revolut being one of them in Europe, where although they've gone through a lot of churn with senior leaders, they've ultimately leaned on those senior leaders from GSIBs to be able to build out their practices. Equally, banks are also looking at fintechs. They're acquiring fintechs to be able to, very quickly implement those systemized processes and not have to, look at the migration of legacy systems. So I think it's just that two-way where you're focusing on the challenges and the strengths of each side, and ultimately there's convergence between the two, and that's really where you're seeing the fintechs win.
Great, thank you. Let's turn our focus for a minute to sanctions, where there is strict liability. Liz, I'm going to ask you, how are regulatory expectations changing, especially in the last 2 to 3 years? And what should firms be thinking about and perhaps implementing because of those changing expectations within the sanctions space?
Yeah, so I won't claim to be an OFAC or sanctions specialist, but I think in part it's because up to this point, or up until recently, OFAC screening was just screening names. A lot of us in the banks and the financial institutions, we would screen against OFAC. Maybe you would screen against the CIA PEP list, and if it was a match, great. Most of the time, it's probably not a match, and then you move on. The change that I have been seeing in the past couple of years has been really a focus on that 50% rule, and actually having analysts that are specializing in sanctions in OFAC and in doing the analytics and the research on where the money is going. Who is it going to? Who owns those businesses? Does it fit into the 50% rule? Do you have the technology to identify who those individuals are and what their percentages are? It is moving very quickly past, even just for smaller institutions that have very little in the way of intentional international activity being a focus, as opposed to just wires that go in and out. There's a need to hone in on those OFAC specialists, on those sanctions specialists, even if you're a smaller institution, and start to understand that much better. It is getting far more complex, and the traditional kind of OFAC screening, yes, it's a hit, no, it's not, isn't really going to fly, I think, in the coming years. There's going to be an expectation that you have a dedicated person or some resources that are actually allowing you to do deeper screening and deeper understanding of where funds are going, where they are landing, once that wire is completed. And you're going to need things like WorldCheck or other vendors that are able to do that. It's becoming a necessary even for smaller financial institutions.
Could I just agree for a moment? I definitely think that there's an enhanced challenge coming out of the kind of qualitative aspects and risk understanding that banks need to apply. But I want to go back to the because I also find that the long-standing challenge of false positives and the screening and that comes from designations is still very much with us. And we have seen a lot of improvement through automation in this, but I feel like that I want to challenge the vendors to get better on their fuzzy logic to make it more efficient, to be able to deliver rules that more efficiently than squelch out some of the false positives. And we understand that it is the bank's obligation to finally tune the system to their risk appetite and that works to them. But I've seen a lot of systems delivered that are still a blunt instrument. And there's a lot of time and money spent on reducing the initial output in particular, but even the ongoing output to something that is truly useful, much less insightful, if we can get to that.
And if there's anyone in the audience that does trade finance or there's been a massive focus the past 5 years by the regulators on trade finance and making sure that all parties that are involved in a trade transaction are screened from a sanctions perspective, but also from an AML perspective, and really having a process that combines those two things. We had to do a lot of work at my bank on trade finance and to really build a very comprehensive process that covers everything. So we actually have a dedicated team, our trade due diligence team, and then they escalate to my team on the sanctions side, and then they will do a full analysis to see if there's anything really there that we should be concerned with. So that has been definitely an area of focus in terms of sanctions on the trade finance space. So if anyone in the room does trade finance, I just want to highlight that. And then I think the other area is the focus on the cartels. So the drug cartels were designated earlier this year as terrorist organizations. So that immediately puts them into a whole separate category. So they're not just a name on the SDN list. There is actually a lot more that comes with that terrorist designation. And I think it's something that we have to think about in terms of ownership, to your point, Liz, and really drilling down into the ownership. So it's not necessarily always looking at 50%. You need to drill down further. And you have to see what your risk appetite is. What is your risk appetite in terms of looking at beneficial ownership? And are there certain customers that you need to drill down further? A lot of us have 25% for low and medium risk clients or maybe low risk clients, and then we have to get 10% ownership for high risk clients. That's kind of industry standard and has been for a long time. But are there instances where you need to drill down further? Because if there are any cartel affiliations, that could be problematic.
And if I could add on to, I think it's going to be very important to invest in the specialists in that area of expertise. There is so much to learn in this space, so trying to have your AML specialist or analyst or investigator also be your OFAC specialist. Sanctions are incredibly complex and confusing, and they can change every day. Then you start getting into different countries' sanctions and trying to put that onus of having your AML specialists also understand all of that complexity it's really going to be important to invest in the different resources that are out there for individuals to become certified in sanctions, and to focus their time, even if it's 20, 30% of their time, but on understanding. Those of you who are in smaller institutions, I'm sure you get notifications from maybe retail or your other internal stakeholders who are like, it's a match, it's an OFAC match, and then you look and it's truly not. It's this person who lives in Omaha is not also a terrorist in Iraq. So it's going to be important for folks to focus on getting that education and making sure you have somebody who can hone in and understand and analyze that activity.
So let's talk about digital assets for a minute and how criminals are exploiting digital assets for money laundering. And how effective are the current AML regulations in combating crypto-related financial crime? So Liz, I know this is a topic that's near and dear to your heart. So I'm going to ask you what you've seen in this space as far as criminals exploiting digital assets.
Yeah, so my experience is at smaller institutions. I did work at State Street and at Santander, but for the most part, it's going to be more regional. So everything I'm saying, just keep that in mind. For the most part, at the smaller institutions, the regional institutions, the money movement that I see with when it comes to digital assets, it's being used basically as like an investment tool. And what I mean by that is folks who already have money are moving money into Coinbase or Robinhood or Gemini, and then they're cashing out. The average person that I know is not using cryptocurrency to buy coffee down the street. They're not using it to pay their bills. They're not using it as it was promised it would have been used 10 years ago. We all heard about how Bitcoin was going to take over and this was the new way of paying for things. And speaking strictly about, United States and smaller regional banks, I just don't see that. Instead, I see investment, moving money, making money. And of course, those in the industry will know Jim Richards, who's done quite a bit of research on the percentage of this money that is being used for criminal acts and how it's much higher than fiat. So when we're monitoring for it, unfortunately, on the smaller institution side, really it's about money mules, money being shifted from one individual to the next, and almost inevitably we are flagging that for potential money laundering or fraud or elder financial exploitation. So the days 5-7 years ago where everyone was saying that it was going to be used you could purchase your coffee with it, and everyone's going to be doing that, I just don't see that as being the case. And luckily, the standard, AML software is able to kind of flag those, but there's still a lot of false positives because just because it's being moved doesn't mean that it's criminal. So that's where we're seeing really challenges. It also adds a challenge because you don't really get good at identifying actual suspicious activity. When everything looks suspicious because it's crypto, it gets really difficult to become an expert on that unless you're working at Coinbase or Robinhood or Gemini. So I don't have any great ideas on it, unfortunately, to share, except that it remains a challenge from a smaller financial institution perspective. But I would be interested in hearing how other institutions are handling it.
I'd say from a larger standpoint or larger bank standpoint, where we're dealing with it on the investment side, then those use cases are more manageable, I think. But you've raised this topic, I think, a couple of times, talking about specialization and understanding the risk. And so while de-risking wasn't on the list, I think that it has been a topic brought up by the regulators and the administration around this. And I just want to make the point that from my standpoint, whether it's de-risking or determining whether you go into accepting a risk, it's important that you match the control framework to the particular risks of the product or the customers that are being serviced. So whether you are a small or a local regional bank that's serving international customers, that requires different monitoring models. It requires different understanding of business transactions and those. So there are tenets that need to be understood. And so taking a standard framework and opening it up to kind of universal finance is not going to work, and that's where I take exception to those who criticize de-risking. De-risking is really where you determine that you don't have the right tools available to manage that risk, and therefore the responsible thing is to not take on that risk. And sometimes that means, yes, we won't do crypto business, or we won't do foreign correspondent banking or MSBs. There are other specialists out there who are equipped or will invest in being equipped that can take that business on. But I don't think, while I do think that all legal people should have access to financial services, that doesn't mean that every financial institution needs to provide every financial services product.
I mean, I think you raise an important point, which is the product risk assessment. So before you launch into a new product, or if you're making a material change to an existing product or service, you really need to make sure that you have a comprehensive risk assessment on that product. So you need to be asking those very specific questions around sanctions, how and understanding the geographic footprint, who the target market is. You need to understand the AML risks. So how could this product or service be used for money laundering purposes? And you have to be very thoughtful in that analysis. It all has to be documented, and you have to save that because a regulator will ask you for that. Regulators typically do ask for product risk assessments for new products in your typical exam cycle, which we all go through on a yearly basis. At least the banks do. So I think that's really important to document those risks and make sure you have controls around that, and make sure it's within your risk appetite, and have those tough discussions with the business and between compliance and the business. So let's move on to the next question. What are some of the current challenges and struggles the industry is facing in terms of financial crime? Jim, I know, we've had a discussion prior to this panel today, and we talked about, have things really changed over the last 20 years, or are we still struggling with the same challenges? So Jim, your perspective on that.
Well, my perspective is that it is largely the same. We have the predicate crimes and the for instance, the current national priorities don't really include any subject matter areas that haven't been considered within global programs previously. So there's nothing new there, and the fact that there are 8 of them or so now doesn't really limit the landscape that needs to be covered from a financial crime standpoint. And it doesn't even include, for instance, what are not the national priorities, which are the law enforcement interests, of other crimes that are prosecuted for money laundering throughout, and upon which local and regional law enforcement rely on information from the banks in a very large part. So it's not like you can stop doing CTRs, or you can stop filing on local frauds or financial crime because you're focusing on those 8. So I don't see a whole lot changing. I do, again, as I started by saying, I think I'm encouraged by seeing some of the advanced technology. If we can get that technology more associated with better data and more complete data, then I do think that we can start to address some of these traditional challenges in new ways. And that's what I look forward to doing, is trying to, rather than replicating the traditional approaches that we've had to financial crime management, if we can look for innovative ways and bring our regulators along with us to convince them that what we are doing looks very different. It may look very different than what we did previously. However, we believe it is still effective. So we need to have that credibility with the regulators to be able to take them something that looks very different and to help them understand that we think that this helps us meet our obligations, and is effective in fighting financial crime.
Yeah, that can definitely be one of the most effective things to do when you're implementing new technology, is really bring the regulators along from the very beginning. Let them know that you're going to be looking into this technology. Let them know what your plan is. What does the strategy look like for implementing this? Are you doing a parallel run? How are you reporting metrics on the success or the effectiveness of this new technology, and really bringing them along and giving them periodic updates as well. I think that's been really, really key.
And if I could, I've been thinking this since Superintendent Harris spoke this morning, where she was talking about, that her financial institutions are coming in and explaining this, and she's impressed. One of the things I'd like to do, again, is to challenge the fintechs out there and challenge the RegTechs out there to partner with your customers. And what I hope to see is that as there's common technology and common sources, whether it's embedded in the AI or other solutions, that the vendors are being more proactive in helping the regulators understand that this is a responsible approach, that it is an effective solution, and so that it's not just on individual banks to one by one demonstrate that it works.
Well, perfect segue to Freddie to get your take on this. What guidance would you provide to the industry today in terms of combating financial crime as it stands today?
I just want to, I'll answer that question, but I want to follow on from your point. And, large institutions have the challenge of governance, procurement, legacy systems to move. And that can take quarters, if not years. And so it is really important as a vendor for us to sit down and really understand our clients' needs. What we're seeing in the market a lot of the time is you have vendors that have this sort of take it or leave it approach, or we know best. And I do agree that a lot of the success stories in these large projects is around understanding the client's needs, understanding the problem statement, and then mapping that directly to the outcomes, rather than having this, features and functionalities word salad that we see a lot. But to get to the question, controls from my perspective have been designed to detect and report, and I think we need to move to an area where we're talking more about predicting and preventing. And I think the answer really sits with AI. But I can't believe I'm going to say this as a vendor, but MIT just reported that 95% of AI pilots fail. So there's still a lot of work to be done. And the key reasons for why these projects fail is not always because of the AI effectiveness. It's because they're either not explainable or auditable, a really important point for highly regulated institutions. They're not using data that's real world or secure. And then the third element ties back to the point I made at the start, which is they're not aligning properly with the operating model or the target operating model. They're seen as this layer on top, which normally isn't adopted properly. So, that's the challenges, but, firsthand, I have seen success stories. Not in my day-to-day, but I advise financial crime, RegTech vendors, early stage ones, and where they're seeing the success is in the application of AI around reducing false positives. In some cases, there's a full autonomous agentic process for automating low-risk transactions. I will caveat that, though. I've just moved to New York from London and opened up a few bank accounts, and I've experienced firsthand automation of sending low-risk transactions and my bank accounts being blocked. So there's definitely still a lot of progress to be made there. In terms of what's very close to my work at Corlytics, and an area that I think we're making huge developments is around the second line regulatory change management activities, whether that's for financial crime or other non-financial risk teams. And one of the big challenges that we're solving is that we're taking typically large volumes of regulatory information, whether that's not just changes but developments in regulatory risk, and we're really isolating that information to the most relevant and accurate pieces of information that you can action. The next stage, and where this is where our generative AI capabilities, at least at Corlytics, are providing huge value add, is not just, this information is relevant, it's interpreting it, it's decomposing it so that you have only the most applicable obligations and requirements, and you're able to then compare that to your internal products, policies, procedures, and controls, and creating these indelible links or connectivities that are no longer having that, I guess, sorry if there are big four in the room, that cottage industry of spreadsheet analysis where you go back and forth and have to repeat the process every year. We're creating that dynamic link so that you have that complete through piece from internal regulatory environment to your external regulatory environment. I'll stop talking in a moment, but one of the common denominators here is making sure that your AI projects are explainable and auditable. And I think one thing to look out for when you're speaking to vendors is an ISO 42001 certification. It's the new global standard for AI auditability and governance. And it's a really nice credential to look out for because it should give you confidence that models are being implemented in the right way.
So I think you touched on quite a few important points, and also how we can be more preventative instead of being reactive. Yeah. A lot of times the financial industry is touted as being more reactive, especially in the financial crime space, than we are being, than our focus is on being preventative. And I think with some of the new technologies out there, it allows us to be more preventative, but we have to, it takes years sometimes to implement these new technologies, and especially in the right way. I think you touched on a couple of very important points there. So Jim, I'm going to ask you how we can use past enforcement actions to look to the future. How should these non-traditional financial institutions look at their program and just make sure that they have controls for each of the pillars, that they're implementing each of the pillars of a successful program, an effective FCC program, and looking at non-traditional ways, as you mentioned earlier, to cover traditional risks and controls.
Okay, thanks. I mean, hopefully this isn't new, that it's recommended that anytime that there's an enforcement action that comes out, that the compliance department reads and analyzes that and determines how they match up. Unfortunately, oftentimes the enforcement actions don't have a lot of specifics within them, but in some cases you can read between the lines, or you can get and some very serious enforcement actions or deferred prosecution agreements have very specific information about the factors that led to that. But I think it's important to objectively look at what went wrong in a previous institution, another institution, and to do a formal mapping of those observations to your own program, and a critical mapping. Now, again, to echo, I guess, the sentiment that it's having been in this business for a long time, and seeing cycles of enforcement actions of similar banks having similar actions, or the same kinds of issues applying to many, many banks, that banks are not learning from one another, if you will. Having said that, I think that it's important that we look to, again, challenge to match our control environment to what is effective for our risk. And that means having an effective risk assessment where you have the inherent drivers of risk, and then matching the controls to that. And if that differs from your peer banks, then you need to, that's okay. We're not, our peer banks, I'll confess for ourselves, we're not doing it well. Now, as you mentioned, we're not really predicting risk. I think there is some prevention and detect, but it's primarily detection and regulatory compliance that we've been chasing. So again, challenging ourselves to do things differently and to do things more efficiently, but being driven off of that baseline. So when I hear fintechs say, "Oh, we don't have regulations out there that apply to us," all the principles are out there, and so and I think that the better fintechs have taken this approach as well, that they've accepted that the principles of risk apply. If you're moving value, then the same kinds of risks and the same vulnerabilities of illicit finance and terrorism and corruption, all exist. It doesn't matter whether it's fiat money or crypto or other value transfers. So again, take those principles and then look for controls that look to build controls that match to your risk profile, and again, don't be afraid to break the mold and do it differently if you think that's warranted.
I'd also add on, I agree 100%, and I believe that ensuring the financial institution and the fintech partners are partners in the endeavor. The best relationships that I have had with fintech partners is when we treat it like a partnership. 5-6 years ago, it was a little bit more challenging before the enforcement actions came out, because it was a bit, as we say, like the tail wagging the dog, where it was about moving quickly, move fast, break things is one thing that I heard a lot of my fintech partners say, but that doesn't work in compliance. You can't move fast and break things. And there was a challenge in understanding and getting that balance. Now, instead of having to say, well, we'll probably get in trouble if we do XYZ thing, or, waving the red flags and maybe not being listened to, the enforcement actions are there that prove, yes, you will get in trouble if you do not follow these regulatory requirements. We have to move slow in compliance, slowly and methodically, intentionally, and in our anti-financial crimes frameworks, making sure that we build things together, that we are constantly in communication about trends. When it comes to AML, it tends to be a bit more detective. I mean, I'm not entirely sure how you would prevent money laundering from happening entirely in your institution. It's more about kind of finding it when it has happened, but then also just partnering with our fintech partners and truly living in the spirit of that word, partnership, and understanding that these new technologies will be exploited. The folks that we are working against have unlimited funds, no budget, and no morals, ethics. They're using slave labor to get their money made. And we have to be on the same page about what we're going to do as a partnership between the fintech and the financial institution to identify the potential risks, be realistic about those risks, and what we need to do to ensure that the bad actors aren't using the products for money laundering, fraud, exploitation, human trafficking, and whatnot.
Can I just add that in addition to the end risks, the use of fintechs and the introduction of vendors into the process creates a new obligation, and that's third-party risk management and managing your vendor relationships. And the various regulators have guidance out there that I think is excellent, that puts out a framework from the time that you start to identify whether a vendor might be appropriate to how you are assessing and having a feedback loop with your vendor over time. So I encourage everyone to the enforcement actions that have come out have increasingly emphasized banks or financial institutions that haven't sufficiently done that or haven't sufficiently documented it. Again, I know from personal experience, sometimes it feels like a thankless task or something we get to last, but it's really moved up on my radar screen as an area, as the fintechs become more central to the solution, they need to be more central to the risk management, and we need to be holding them accountable. We need to be partnering with them. They need to be partnering with us, and that needs to be a part of the service that they're providing. So it's not just the underlying technology, but it's the relationship. And so the guys that are out there selling, I'm sure, hopefully, they're emphasizing that partnership and that long-term journey that they want to take with the financial institution.
And I believe it's the OCC guidance that is probably the most comprehensive. So if anyone has not seen that, just go onto the OCC website, and there is very specific guidance on third-party risk management. That's really excellent. Yeah, that I know all of the banks are using. Absolutely. And just to go back to the enforcements for one second, I've been at 3 banks now where I've been involved in the remediation of enforcement actions, deferred prosecution agreements, consent orders, and lately a written agreement that we just got out of. And I'll tell you, one of the core elements of why the enforcement happened in the first place was governance, a lack of proper governance, so that concerns and escalations were not heard by the right people. And if you look at the recent enforcement actions, namely TD Bank and some of the other ones that have come out, you will see that concerns were not escalated appropriately. They did not get the attention of the right people, and those concerns were not documented correctly. So governance is really a key theme in really all of the enforcement actions, and it was something we had to keep in mind throughout every single part of our remediation. So even if it was something on a transaction monitoring system or sanctions screening and changing thresholds, we had to make sure we had proper governance around that, and also make sure that it's not a single decision maker and that you have multiple people involved who can give different perspectives. So that's just something to add on the enforcement action, since I've near and dear to my heart because I've been at several institutions in helping those remediation efforts. So we only have a few minutes left. Maybe I'll open it up to the audience to see if there's any questions anyone has. Don't be shy. No questions, really? Okay, well, then maybe I'll ask each of the panelists to give their key takeaway. I would ask, how should financial institutions prepare for changes in enforcement? And what are your key takeaways from the messages in this panel, or for the audience here? Maybe Freddie, we'll start with you.
Sure. So, I mean, just to continue the point of the importance of enforcements, I think not everyone actually takes the time to look at them and understand the key mitigating factors, the deficiencies, and the failures in the controls. And although it's always, I always use the metaphor when you're driving, it's always important to look ahead of what you need to comply with. You do need to look in the rear mirror, and so enforcements are very important. In terms of just looking to the future, I'll just repeat the point. AI is definitely going to be part of the framework of which you manage all of your financial crime defenses in the future. It's just taking the time to make sure that you have the right data, governance around that data, that it's auditable, it's explainable. Otherwise, unfortunately, those projects probably won't end in a good place.
Liz?
I'm going to piggyback off of what you said about third-party governance and BSA, AML, or financial crimes. I think my peer in third-party governance is my bestie. It is really very important that we work together. In the past, prior to the enforcement actions, those contracts that we were drafting up with our fintech partners, they were not good enough. They weren't good enough for me to get the information when I needed it. There was a lot of pushback on, well, show me in the regulatory framework where the law says that I have to give you this information. It wasn't documented clearly that, if the BSA officer asks for it, we need it. And that third-party governance has been really a life changer in terms of having specialists who are in that space. And if you're in the anti-financial crimes space as a BSA officer, a fraud officer, or director of an FIU, working very closely with that third-party governance partner and making sure that your contracts with your fintech partners outline specifically what you need so that you can get all of the data that you need to prevent, detect financial crimes of all types. That is very important and has been one of the positives that has come out of the enforcement actions that I've seen.
And Jim?
So I wanted to pick up on your point about raising your expectations, raising what you need to the right levels. And I think that within the financial crime department, everyone needs to lead from their role. And so if you need resources, if there are things that you believe that you need, whether you're in a department or you're the head of the program, you need to ensure that your supervisor, that your team is aware of how you assess the risk and what you think is necessary. And to ensure that it's their job to evaluate until you know, ideally explain why that's okay, that it's not going to happen, or to help them recognize a risk that they may not have risked before and to address it. And so it's particularly challenging at the BSA level, where you're presenting to the board and to executive management. And I can say from experience that notwithstanding the great authority and responsibility that we have in these roles, there remains a large power imbalance. And you look at just what the compensation is between a compliance officer and an executive business owner. And while they both may have a seat at the board, the power imbalance is not always equal. Having said that, we need to exert our power through the responsibility of the regulations and what we have. And sometimes there's an art to how you present that. You have to do it very carefully, and but you also need to ensure that it's done clearly and that you are making the requirements that you've assessed are necessary to be compliant, to be effective, to the board and executive management, so that they can then determine whether or not that gets adopted in part or in all. And oftentimes, this is not a mandate, this is not a demand. This will be a partnership also with your management and board to determine the right way forward. But having said that, just complaining about it either at home or within your staff meeting is insufficient. You need to ensure that executive management and the board are aware of your expectations.
Great. Thank you so much, Jim. Well, I just want to thank everybody for attending the session today. Hopefully you had some good takeaways. Please feel free to reach out to us if you have any questions. I think our emails are probably through the app. And I just want to thank Freddie, Liz, and Jim for their insights today. So thank you so much, everyone.